Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and joining us. And hard to believe that this is our last show for the month of November. I cannot believe how fast this year has gone by. Only a few shows left before the end of the year, before the holiday season begins. We have, I guess, less than a month to Christmas. I'm sure all of you, or many of you, are already knee deep into your Christmas shopping. Hopefully you are. I know there are a lot of last minute people out there looking for gifts, but hopefully you will get that shopping done early. I know in the US this week we have a short week of trading because they're Thanksgiving. Tomorrow markets are closed. Friday they're only open half a day. So it's just really amazing to see how fast this year has gone by. But as always, we have an information-packed show for you this afternoon. Let's put up our show topics. There they are. The first topic, a very interesting one. With 26 years of investing experience, how is Allan, how am I investing right now? And this topic came up because I've been receiving many questions about, is there going to be a major correction? Is there a big pullback? Are we in a tech bubble? Been getting a lot of questions about this. And interesting enough, the retail investor, unfortunately, is always a little late to the party. And we're actually seeing the markets go higher in the last few days, even though I keep getting these questions about a very large pullback in the markets. Now, of course, not saying it still cannot happen, but the market has definitely rebounded in the last few days. And today, before we came on air, the market was higher once again. So we're going to talk about how I have been investing right now and just some thoughts around that. Top 3 things to consider over the next 5 to 10 business days. We always talk about 3 things, very popular segment of our show, 3 ideas that investors should be focused on. NVIDIA reported strong earnings, but the stock dropped. Why? Why did a company that reports 62% growth in revenue year over year, how does that company's share price not go higher? Well, I have an idea as to why it didn't. Are this year's markets breaking with historical seasonality or seasonal patterns? The answer is simply yes. And I'm going to show you why that is unusual. Normally, for example, November is the best month of the year for investment returns. Yet this November 2025, has been a struggle for the markets with only just a few days left. This month definitely proving not to be the best month out of 2025. Bitcoin slides, and some suggest the path back will be harder. Something we don't talk about a lot, cryptocurrency, Bitcoin. What's going on in the crypto land? Well, we've seen a major decline in Bitcoin, down almost a third from its highs. It's bounced back a little bit recently. But why is this happening, and what can we expect going forward? Quick hits, 3 things that I've seen in the news over the last few weeks that I wanted to make a brief comment on. And last but definitely not least, your questions. If you have any questions during the course of the show, please put them in the chat boxes. My team will pick those questions up. Love to answer them at the end of the show. And if we don't get to them, definitely we will hopefully answer them by next show or on our next show. So let's move on with our show. So how have I been investing over the last few weeks or last few months? The talk about perhaps a recession, a major pullback, a tech bubble bursting, all the talk has been pretty negative out there. The media has done a pretty good job causing a little bit of doubt, producing a little bit of doubt in the minds of investors. And I would say there's a great deal of fear. I can't tell you how many messages, emails I've been receiving about a possible correction in the market, and a large one. And my answer has been very simply, corrections happen on a regular basis. We tend to have a few 10% corrections, or let's say 5 to 10% corrections in any given year. Not to mention we tend to get larger ones, maybe once or twice every 5 years, like the 20% type that we received or that we went through back in the spring, March and April of this year. the 20% kind, the bear market kind of pullbacks. So we do see those types of minor corrections, larger corrections. They happen on a very often, especially the 5 to 10% corrections. And people will tell me, well, is there a way we can prepare for it if we're expecting it to happen? Well, the short answer is it is extremely hard to prepare for these types of minor, I will call them minor pullbacks, the 5 to 10% pullbacks. You may not think it's so minor, but in the grand scheme of things, they happen so often that the market and investors should look at them as minor or even healthy on the way to bigger and higher markets down the road. But let's take a look at the S&P 500 over the past month. There you have it. That's what the S&P has looked at or looked like for me and for how it should look like for all investors. So you have a bit of a slowdown as you moved into November towards the end of October. And then you had a bit of an uptick around November 10th and 12th. So if you're an investor or an investment advisor like myself, yeah, you see a pullback, but then you see markets go higher. Nothing that we have not seen before. Then we see from about the 12th of November all the way to the 20th, the market decline. And that decline was the big one, or at least the 5 to 6% range, if you want to call that a big one. In there you had NVIDIA results that came out, the market was disappointed for whatever reason. We'll touch on that shortly. And that was kind of the final nail in the coffin to take these markets down, 5, 6%. But as you can see there, until then, the market was just moving up and down as it always does. So by the time we realize, or I realize, or investment advisors or even investors realize, hey, you're down 5, 6%. This is one of those run-of-the-mill 5 to 10% corrections. Perhaps it was too late. When do you sell? People ask me all the time, when do you protect your profits? Well, I can tell you, you don't sell and realize those profits when markets are going down. When markets are going down, that's when you buy into this market. When you sell and protect your profits is when the markets move higher. And so at the point of November 20th, roughly, just before that, November 19th, market is down 5, 6%. Everyone is saying, maybe we should be selling. Should we be selling? Well, no, I think you should be buying. Why? Well, let's go to our next charts. Let's take a look at a chart for Meta Platforms, formerly known as Facebook. Look at that chart. Yes, it started to come up after the 20th, but it was down 25%. Overall market was down 5%. But do I want to sell Meta? No. It's a fantastic company with fantastic earnings, and the stock has just gone down because of the amount of spend that they're doing, a tax hit that they took, a one-time tax hit, reasons that, in my opinion, are silly. This stock should never have been down 25%. So I'm a buyer. I'm a buyer when this stock falls as it has. Again, if you can handle the risk involved in owning a name like Meta, yes, it was, and it still is, perhaps a buying opportunity. Let's move to Oracle. Stock market falls 5, 6%. Oracle is down till this day, actually, 40% from the high. Now, maybe Oracle shouldn't have been that high to begin with. That is quite possible. But I do not think Oracle should be down almost half, lose almost half its value from its high. So again, am I a seller of Oracle? No, I'm a buyer. I'm a buyer on weakness in the markets because there are many more things to buy now than just a few weeks ago. The end of October, we were hard pressed to find good bargains, and now we have many of them. Another chart we have here, Advanced Micro Devices, AMD, chip maker, probably the biggest competition for NVIDIA right now. And look at you have there, a sell-off in AMD. At one point, AMD was sold off by about 25% on the recent 5 to 6% pullback in the S&P 500. Am I going to be a seller into weakness? No, I'm going to be a buyer of a name like AMD. Again, if an investor can handle the risks that go along with buying AMD stock. So again, if I'm buying when the market is weak, and I just said I'm actually buying as well when the market is at all-time highs, yes, you're right. I'm buying always. I'm always buying into this market because, as Jim Cramer says, who's very famous at CNBC, some of you may know the name, he's always saying that there's a bull market somewhere every day, and it's his job or the job of the investor to find it. And I agree with that. So when do you realize returns? Well, let's show our next chart, S&P 500 chart. It's a 1-year chart. There you have it. You sell in July, you sell in August, September, October. And I don't mean sell out of the market. Trim those profits back. Trim some profits, move that money, some of those profits into names that haven't moved up as yet, into cheaper names. That's when you sell. You don't sell when you need to sell or when you're fearful or when the market is falling. That's when you buy. But when the market's doing well, you trim some profit, so you're a seller, and then you buy weakness somewhere else. When markets are falling, you don't sell because a lot of names are down 20, 25% at times. Obviously, not everything is down that much, but you want to be more of a buyer because there are things on sale. You'll obviously want to buy low to sell high. And ever since we had the markets in April, a big sell-off of almost 20%, the markets, for the most part, have been on a pretty nice run from the bottom left to the top right. Our last chart for this segment shows the S&P 500 over the long term. There you have it. This is I guess it's about a 10-year chart for the S&P 500. And you can see over time the pattern, right? You have a run up in the S&P or any index. It pulls back a little bit, and then it runs higher again, back to the all-time highs, and then surpasses those all-time highs. It makes new highs. Makes new highs for a period of time, pulls back again, markets consolidate at a lower level, and then has another run to the previous highs, and then passes those highs once again. So it's a series of new highs, back down, new highs, back down, and that is how the markets work. So yes, as long as you own good quality names at good valuations, this is the pattern that you can expect. But of course, investors get nervous. They don't like to see their portfolio down or the market's down 5 to 10%. Everybody can say, yes, we expect it. We know it's going to happen. But when it happens, it's pretty difficult for some investors. And there's always that question, could we do anything to protect our portfolio, to prevent this from happening, from the portfolio from falling when the markets fall as well? And the answer is probably not. You want to protect the portfolio a lot sooner or a lot earlier when things are good. You don't want to protect when things are more challenged. That's when you actually want to take advantage of the opportunity. So for all of you that have either sent me a message, spoken to me, or for those that have been wondering what to do and expecting this big pullback in the markets that just hasn't happened yet, I can tell you, yes, there will be a pullback. And yes, it will be 5, 10%, maybe greater. But I also will tell you the markets will rebound at some point and move higher again from there. So let's not get boggled down necessarily in this wondering when the next pullback is. Let's enjoy the run that we've been on since April. And I believe the run we're going to be on from now until the end of the year, I think there's a good chance for a Santa Claus rally, especially if we get a cut in interest rates in the US and we're seeing more efficiency. Businesses are reporting good earnings. And I think we could have a good December and into January. So let's try and maximize opportunity when we have it. Enjoy the good times because, yes, unfortunately, those pullbacks do happen, and they do happen on a regular basis. Now, the part of the show where we talk about 3 things that individual investors need to focus on before you make your investment decisions. The Fed December rate cut expectations have jumped. Yes, just a few weeks ago, we weren't expecting a rate cut, and now it seems like there's a very good chance we will get a rate cut. Very important. We'll all be focused on the Fed come the early part of December, I think somewhere around the 10th of December, and let's see what they have to say. Canadian bank earnings, they're coming out next week, within the next week or so. I'm looking for some good earnings, but as you're going to see shortly, we're coming into the earnings season at a high point. And whenever you come in at a high point, maybe you're going to get a sell the news phenomenon. So investors have bought into the banks heading into earnings season, but maybe once earnings come out, could we see the market for the bank stocks, Canadian bank stocks, sell off a little bit? I think it's quite possible. Individual investments have limits. they don't keep going in a straight line all the way to the moon. And I've heard us talk about Nvidia. Can't sell our Nvidia shares because they just keep going up. Why would I do that? We can't sell our Apple stock. I heard that for many years as well. Things always have their day where they go up and up, and then eventually, don't go up as quick, or perhaps come down a little bit, consolidate. And over time, good quality companies have their shares do run higher, but nothing goes straight up and to the moon. So we're going to touch on that as an idea to focus on as well. So let's move on to our first topic, Fed December rate cut expectations. And as I said, they've definitely moved up significantly. Our first chart here shows where the Fed has gone in the last little while, target range for Fed funds rates, and you can see how it's starting to come down. And I'm sure to President Trump, I'm sure he's quite happy to see rates come down, but for him, I'm sure not fast enough. He continues to poke fun at the Federal Reserve, Jerome Powell, the head of the Fed, saying that can't wait till he is no longer in the job. And when he replaces him, he will put in someone who is, I guess, friendlier or more willing to cut rates over the coming years. So the market's gearing up for a rate cutting friendly Fed head, if you will. I don't know what else to call it, but the market is expecting that interest rates will be cut throughout the year next year. And if that is the case, I'm sure the market will get a boost from it. Our next chart here, Fed Watch Tool, probabilities of FOMC rate cut. And you can see here on the left-hand side, December 10th rate cut as of November 19th, only a 30% chance. As of November 25th, just 6 days later, 84% chance, over 84% chance. And if you go ahead into 2026, you can see right now, they're just under a 25% chance they'll cut again a quarter point. But right now, I guess the talk is that they'll hold pat and they'll stay about a 65% chance that once we get a cut in December, we will not get any more cuts. At least we will not get a cut in January. Now, what changed things in just 6 days? Well, Fed speak, as we often say. The head of the New York Fed spoke, Mr. John Williams, and we have his quote here. When the head of the New York Fed speaks, everybody listens because they are considered a very important part of the Federal Reserve. Let's put up the quote on the Federal Reserve rate adjustment. There it is. I view monetary policy as being modestly restrictive, although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range for the federal funds rate to move the stance of policy closer to the range of neutral, thereby maintaining the balance between the achievement of our two goals. And what their two goals very simply are: full employment and stable pricing. And what this tells me as the New York Fed, John Williams, is focused on jobs and the decline that we're seeing in jobs in the US, although the September jobs number was actually above expected. Obviously, we don't have an October number because the government was closed, so we didn't get that data. But just seems like someone like John Williams, the head of New York Fed, is focusing on that. There are 3 or 4 Fed officials focusing on that and on jobs and think there should be a rate cut. There are 3 or 4 Fed officials that are now focused a little bit more on inflation and think that they need to take things slowly. And then there are a couple of others that are somewhere in the middle. So the Fed is definitely divided. Our next chart shows PPI numbers, producer price index. These are their wholesale prices. The main takeaway here is the far right-hand side, PPI and CPI, which are your consumer prices, they still seem to be showing inflation at around 3%. Let's say 2.5%, 3%. That hasn't changed really for quite some time. And that gives ammunition to the Federal Reserve to focus on jobs in this case, although I'm sure Jerome Powell, the head of the Fed, will tell you that they want to see a 2% inflation rate, not a 3% inflation rate, and that a 3% rate is actually 50% above what they want at this point in time. And the Bank of Canada is no different, although inflation here in our country is much closer to the 2% target than in the US. So inflation, at least for the most part, is stable in the US, but still not coming down towards 2%. Our next chart shows a chart about the US consumer consumer sentiment. How is the U.S. consumer feeling right now? And this tells me a lot. This says the U.S. consumer is not confident. The lowest numbers that we've seen on the right-hand side, those are the lowest numbers we've seen in many years. You got to go back maybe over the last couple of decades before you saw a number, looks like a number around just before 2012 or maybe back in 2008. But definitely it's the lowest we've seen. So the consumer not confident, and that could play out in the markets. That could play out with spending. We know the U.S. consumer makes up about, well, over 70% of the U.S. economy. So if they're not confident, if their sentiment is low, then that is a negative for growth in the economy. And again, perhaps something that the Federal Reserve could say, hey, consumers not confident. We're seeing jobs growth not there. Companies are laying off workers. Amazon just laid off, I think, 13,000 or so. This is an opportunity and the time where they need to cut interest rates a quarter point. So what is the market doing right now? Our last chart shows it's pricing in already a quarter point. The 10-year Treasury now coming down towards 4%, went slightly below 4%, but hovering in around 4%. So I would say it is highly likely that the Federal Reserve will cut rates at its next meeting. Our second point to be focused on if you're an investor right now over the next few weeks, as I said, off the top of this segment are Canadian bank earnings. And I'm expecting really good bank earnings. I'm expecting the banks to report good numbers, perhaps even some decreases in the money they're setting aside for bad debts. I'm expecting their business activity to come up a little bit. We've seen business activity in Canada really slow down like 25% the last time we saw that number. I'm hopeful that that part of the business is starting to come back. It'll be interesting to see what banks say with regarding loans. Are they still lending as much to businesses to grow and expand? What are they saying about wealth management, net interest margin? That is the gap between what they pay interest on and the interest they charge on loans. What is the spread right now looking like for Canadian banks? And what are these banks doing outside of Canada, internationally? Obviously, our banks today are a lot more international than they used to be. Even CIBC has now a lot more business in the United States. Royal Bank, TD Bank, Bank of Montreal, Scotiabank, probably the most global of our Canadian banks with business in Central America and South America. What are they saying about that type of business? As I mentioned, coming into these bank earnings, I'm a little cautious, not because I think the banks aren't going to report good numbers, but I'm just a little cautious because their stock prices have all run up. All the major banks seem to be at either all-time highs or at the very least 52-week or one-year highs coming into their numbers. And we have a couple of bank charts here. TD Bank, after they went through all the negativity regarding their money laundering and their U.S. business and that business being kind of on hold right now, they can't expand it. Look at the chart for TD Bank. Unbelievable. From mid to high 70s stock price to over $116 per share. Bank of Nova Scotia, the one bank that was sort of left behind, undergoing a restructuring. Well, obviously that restructuring has been fantastic. Look at that share price. Again, going from as low as $65, $63 a share at the low to $95, 50% return. Unbelievable over the last little while. And our third bank, which is a bank, our largest bank, the bank that has been just humming along for quite some time, Royal Bank. I think if anybody has owned shares of Royal Bank, even though it is one of the more expensive banks to own in terms of earnings per share, PE ratios, etc., it just seems to keep climbing. And yes, I guess it's been climbing a little more gradually than the other banks, but still climbing nonetheless. And when you take a look at banks in general, these are all the banks, major banks. We have an ETF, the Hamilton Enhanced Canadian Bank ETF, and this will show you how well the banks have done. So heading into this earnings season, little concern, right? A little concern that, maybe the banks have run a lot. And when you tend to see times like this, maybe you get a bit of a sell-off when the numbers come out. Again, we always say you buy the rumor and you sell the news. Well, the rumors are bank earnings are going to be just fine. And when it actually comes out, maybe the banks just don't take another leg higher. Maybe they just stay stable or maybe even pull back a little bit. If they pull back too much, that gives us another buying opportunity. So we'll have to watch what the Canadian banks say. Our third topic of our top three, individual investments have limits and they just don't go straight to the moon. And it's interesting because the last time we talked about a stock like Nvidia going to the moon, can't sell Nvidia, just going to go up, up, and up, it was Apple stock. And let's show a 5-year number, a chart on Apple shares. There you have it. Well, that doesn't look like a stock that has gone to the moon over the last 5 years. It's gone up, it's gone down, very volatile. Recently, it's gone a lot higher. I think with this whole idea that Apple is going to be using Google or Alphabet, Gemini, AI for their products. And we've all been waiting for Apple to get into the AI game. And so far, they've been holding off for whatever reason. But their new iPhones were a hit globally, even in China. And that has given them a recent burst to the upside. Let's take a look at Apple over the long term. Again, do stocks move higher over time? Yes. But you can see the pattern of Apple. Goes up, comes down, consolidates, goes up, comes down, consolidates. And you can see if you look at a chart, on this chart even, if you look at towards the end of 2021, that was approximately the same value as it was at the beginning of 2024. Nothing really moved higher much, maybe a few percent only. And then when you look at, I guess, a chart 2023 to midway through 25, so maybe a 2-year period, again, Apple really didn't do much. So you'll have periods of time where these tremendous companies, these massive companies, Apple, first $4 trillion company, now it's still there. It's in and around 4 trillion. Sorry, Apple had the first $3 trillion company. Nvidia was the first $4 trillion company. Nvidia is the first $5 trillion company as well. But Apple, being the first $3 trillion company, finally got to $4 trillion in market cap. But really, the stock has been a laggard in the tech space. Perhaps it's because earnings were growing at around 5, 6, 7%, and the earnings multiple, or PE, was over 30. That's an expensive stock to me. So while a name like Apple or other stocks that kind of take off and consolidate, what should you be doing? Well, you should have a diversified portfolio. You should be owning other names, not just Apple or Nvidia or other tech names. You should be owning different tech names, different banks, different names in other sectors. And I have a few here. So while Apple is consolidating, let's own some JP Morgan. Let's pull up a stock of JP or a chart of JP Morgan. Look at that chart. Come down a little bit over the last, let's call it, month or so with the markets. But JP Morgan has had a fantastic run. What other name can you own? Well, let's look at a pharmaceutical name, Eli Lilly chart. A lot of people say pharmaceutical has been dead, and it has for a little while. But why do you stay diversified? People tell me all the time, Allan, why are you owning these pharma stocks? They're not going anywhere. Let's just own more tech. Well, this proves you wrong. Eli Lilly, first $1 trillion pharmaceutical company in the world today. Eli Lilly, famous for their GLP-1 drugs, the weight loss drugs, but they have a very strong pipeline of other drugs as well. And finally, Eli Lilly is being rewarded. So if you had a diversified portfolio, own some Eli Lilly as well. Eli Lilly, JP Morgan, maybe some Nvidia, maybe some Apple, and maybe some TD Bank. Let's take a look at TD Bank stock. Chart that we have there. We showed already what TD Bank stock looks like. Maybe you want to own a Canadian bank. Maybe you want to own a great industrial name, a large company that benefits from building, from infrastructure building. What are you going to take a look at? Maybe it's Caterpillar. Everybody knows the machinery company, the big heavy machinery, the big bulldozers. Caterpillar actually now is benefiting from the data center build out. Why? Because you need these big turbines, and these turbines produce energy, and these energy you need for these data centers. And Caterpillar produces these big turbines, and that is one of the reasons why we're seeing Caterpillar stock move significantly to the upside. So stocks don't all go to the moon, and when they pull back or consolidate, you want to be in other names that can pick up the slack. So you want to have a diversified portfolio. So 3 things to consider before you make your investment decisions. Number 1, keep an eye on the Fed. What are they going to say at their next meeting? Number 2, maybe even in the shorter term, bank earnings, Canadian banks. Don't be surprised if we see a bit of pullback on the earnings release, but I think these banks will continue to go higher over the long term as they have for many years. And last, just remember, don't always chase the hot stock, because stocks just don't go straight up all the time and go to the moon. They have their periods of consolidation and flatlining and actually coming down. And when they're in that type of state, that type of environment, you want to be diversified into other names so that your portfolio can continue to grow even when these hot stocks sort of slow down. NVIDIA reported unbelievable earnings. For any of you that heard about their earnings, spoke to me about their earnings, I've never seen earnings like this before, really. And that even goes back to the Apple days. I'll read you some stats. 62% year-over-year revenue growth. They make up over 8% of the S&P 500. Sorry, they have 8 to 9% of the S&P 500. Over 80% of the market share. 80% market share. And last but definitely not least, on the products they create and produce, they have margins of 75 to 77%. So when they reported these numbers, what did the stock do? It fell. Unbelievable. The stock fell. And actually, that day started off a good day, if you all remember. And then by 10:45 in the morning, stock market reversed. They went from the NASDAQ being up 400 or 500 points to the NASDAQ being down 400 or 500 points. One of the biggest reversals in history for the NASDAQ. The stock market sold off on the great NVIDIA earnings. And we actually have a chart. Let's show the chart of NVIDIA. There you have it. That was NVIDIA, or that is NVIDIA for the month of November. Stock produced the best earnings of any company that I've seen, that I can remember in recent times. And that's what the stock has done. So why has the stock sold off? Well, maybe this is as good as it gets. Maybe investors are saying, how much more can they grow? 62% revenue, over 80% market share, 75%, 77% margins on their product. Like, how much more can you make per product? How much more dominant can you be? It's only a matter of time before Broadcom, AMD, and other chip makers eat into the dominance that NVIDIA has. But for now, it's just a machine. It just continues to sign contracts, to produce, and to grow. And many think that it'll grow probably at least for another bunch of quarters. I've seen targets for NVIDIA 250, 300. I think I've even seen targets over 300, but we'll have to see. Stock price today was up before we came on air, just over $180. So some interesting statistics. We have some illustrations. Let's go to the next illustration, which is NVIDIA beats estimates as growth reaccelerates. That lime green bar on the far right-hand side is the revenue growth I was talking about. Unbelievable. Net income, year-over-year revenue growth is that dark line that started to shoot up. You can see there just above 50%. Well, I can tell you it's over 60%. Our next chart, NVIDIA beats revenue estimates by the biggest margin in a year. And if you look at Q3 2025, it's just off center there. You'll see that it is a higher bar than the two before it. And the last time you saw numbers that well was Q4 of 24. Our next chart here shows the PE ratio. So even though NVIDIA is making a lot more money, look at the price to earnings. The price to earnings is actually coming down on a forward basis. The actual PE is somewhere around 30 on a forward-looking basis. It used to be well above 50 once upon a time, over 40 definitely. And now, with the earnings that they've been having, the actual PE multiple has come down. And that just means that the price of the shares is not keeping up with the earnings. That's a good thing if you're looking to buy shares of NVIDIA today. Our last chart on this segment is a chart that says NVIDIA is still the biggest driver of the S&P 500 success. And you can see 20% almost of the success of the S&P 500 comes from NVIDIA. If NVIDIA is going, so is the S&P. And you can see there Alphabet, Microsoft, Broadcom, 10, 10, and 8% respectively. Total return in the first 10 months of 2025, S&P 500 was about 17.5%. We've seen a bit of a pullback since then, but it definitely due to NVIDIA's run-up, And you can obviously see some of the names: Accenture, Salesforce, Fiserv, United Health Group. Those are responsible for some of the declines of the S&P 500. So NVIDIA, it is important. Makes up almost 10% of the S&P 500. It is a name that we all watch. We all listen for their earnings. We hear or we listen for what their CEO says. Very important to the market. Why it fell coming out of earnings release. I just think the market investors may think that maybe NVIDIA is as good as it gets here. Well, we'll have to see in the coming quarters. Perhaps if NVIDIA is allowed to sell chips to China, which is on the table now with President Trump. If they are, well, that's a new revenue source that has not been included in the numbers, and perhaps NVIDIA can go even higher. So we'll have to see how NVIDIA does, but definitely a very important part of the stock market and many individuals' portfolios. Seasonal patterns. We talk about seasonality all the time on this show. And let's pull up our first chart, actually. And we're going to see that which months of the year are the best for investors' returns. So on the left-hand side, you have January up 1.1%, April up 1.5% average return. And as we've said many times, November up 1.6%. The best month of the year, just ahead of April, but by far a lot higher than most of the other months. And on the right-hand side, you can see best to worst for these months. Standard deviation, meaning how much it's fluctuated over the years. You can see October, a lot of fluctuation, because normally we come into October on a sour note. And then by the end of October, after Canadian Thanksgiving, things change for the better, as we tend to focus on the end of year shopping, US Thanksgiving, Christmas, and things tend to look a lot better. So the volatility in October tends to be a little higher. But let's take a look at our next chart, which I think says it all. Everyone's asking, is this year a regular year with respect to seasonality? Well, this chart tells you no, it's not. And why is that? Well, take a look at the chart. We saw a very big pullback in the month of April due to tariff announcements. But normally, April is the second best month of the year for returns. So seasonal factors did not play in this case. And that saying, sell in May, go away, come back in October, November. Well, if you did that, how much of the gains would you have missed? It would have been a tremendous miss. You would have lost out on a lot of this year's gains. We know the market at one point was down 20%, S&P 500. And by the time we got to November, the S&P 500 was up 15 to 17%. What a massive turnaround, 35, 36% turnaround for the S&P 500. November, usually the best month of the year. What have we seen so far this November? A choppy market, a market that has gone down the last couple of weeks, and hopefully it'll have a good last week as we have a short week this week, as I mentioned, due to US Thanksgiving. The markets will be very quiet, but the first part of this week, Monday and Tuesday, and even today, before we came on air, markets were higher. So are we following seasonal patterns this year? Absolutely not. Why is that? Hard to say. Perhaps it was the tariff announcements. Perhaps it's geopolitics, the political climate, political environment. That's kind of throwing the market for a bit of a loop. But overall, seasonal patterns usually exist, usually are correct, happen more often than not, as we can see. But for whatever reason this year, maybe it's politics, as I said, just doesn't seem to be happening. So whenever an investor says, should we sell in May and go away, or, maybe we should sell out as we're approaching August and September, just understand that these patterns are there because, yes, they happen more frequently than they don't happen, but you just can't always assume that these patterns will take hold. And this year is a perfect example of a time where they don't. Cryptocurrency, Bitcoin. Oh boy, has it been taking it on the chin. At one point, Bitcoin was $126,000 US per Bitcoin. Today, it's in the high 80,000 range and got actually as low as 80,000. It lost, if you're looking at it, a third of its value. just in a very short period of time. Unbelievable decline. Something that, yes, we've seen before. Remember when Bitcoin went from 20,000 down to 5,000 and then surged from there? So we've seen these declines before in Bitcoin. We've seen these declines before in cryptos and digital currency. Does that mean that crypto and digital is not going to last and it's going to disappear? I don't think so. I think crypto and digital currencies are here to stay for the long term. And when I hear the CEO of Visa talking about how they have now digital wallets and crypto and stable coins and all of that, all the stuff that we've been hearing about over the last, let's call it few years now, that tells me that digital currency is here to stay. Our first chart shows the demise of Bitcoin, shows it at around 87,000 US dollars. Look at that chart. Wow, what a fall. You can see if you focus on the far right-hand side, a bit of an uptick. People have now started to buy back in. Institutional investors, businesses, those that were buying have started to buy back in. Looks like the retail investor has perhaps taken a lot of money out and moved it somewhere else. If you look at a name like Ether, and how they've done, similar chart, right? So digital currency as a whole, cryptocurrency has been in tough. Possible reasons for a Bitcoin decline. We have an illustration there. Bitcoin now is institutional investors as part of the mix who have a different mindset. Maybe they're selling and they think it's at a top, and maybe now they're buying in at a low. What is the smart money doing? What are the institutional investors doing? Less liquidity. There's a slowdown in Bitcoin mining, so not as much liquidity out there. Slowdown in liquidity. Bitcoin has 4-year cycles with a drop in supply, and it is overvalued. Perhaps Bitcoin was overvalued at 126,000. I'll throw one more in there into the mix. Risk on. Risk on. When risk is on, when investors are in a risk on mode, they tend to buy things such as crypto and gold and other things. When investors are in a risk off mode, like we've seen over the past couple of weeks, as the stock market has come down 5-6%, so has Bitcoin. And as we know, Bitcoin is extremely volatile, a lot more volatile than the overall stock market. So when the stock market falls 5-6%, crypto is falling 30-40%. And that's the scare, right? There's nothing backing crypto. As I said, I don't think it's going to disappear. In my opinion, it will be here for many years to come. And that seems to be the way the world is going. Digital currency, you don't really see paper currency in many places anymore. Some places say they don't take dollars, they only take plastic or digital type of transaction. So Bitcoin, Ether, look for those to, in my opinion, bounce back at some point. But right now, they're still in difficult as that risk off mode seems to be prevailing with respect to the markets. Quick hits, 3 things that I've seen in the news recently that I wanted to make a brief comment on. Is Canada in a technical recession? Well, the answer is maybe. We saw a negative growth for the second quarter of this year. I'll show a chart in a moment. And if we have 2 negative quarters of growth or GDP, technically, Canada will be in a recession. Rising cost of food, changing how Canadians eat. That's what the surveys tell us. Are Canadians spending as much money in restaurants as they once were? Are they using more coupons? Are they, shopping at discount stores more often? I think the answer is yes, because prices are just too high. And lastly, companies tone down the price hike talk. Well, companies have been getting hit pretty hard because all they keep doing is complaining about the prices and the costs and everything. We're seeing a lot more of businesses swallowing some of those costs, and let's talk about how high prices actually are. So let's go to our first topic. Is Canada in a technical recession? I think our best chart, or our only chart for this, shows it the best. And let's pull up that chart. Look at the red bars on the far right-hand side. So you have April, May, and June. You have July, August, and September. We don't know. We have July higher, August down. Looks like August offset what July. made or the growth in July, we lost in August. The quarter before that, 3 red months showing us a decline in growth. What will September be? We don't know as yet. Can we skirt by again and just miss a recession? This is the question. And this is why I keep harping on the Bank of Canada needs to continue to cut interest rates. And our federal government needs to continue to look at whether they can cut taxes meaningfully, not 1%, but 10%, 15%. Let's get more money in the hands of people so they can spend it and grow this economy. So we'll have to see in the coming weeks what the numbers look like. Will GDP go down for 2 quarters in a row? Our second topic, rising costs of food is changing how Canadians eat. That's what the survey shows. Our chart for this shows the comparison between fall of 2024, the spring of 2025, and the fall of 2025. So the dark part, 48.2%, is the fall. 48.4% is they sought out more bargains or more sales and discounts. So it was about the same. Jumped up to almost 49% in the fall of 2025. We go down to the shopped at cheaper stores. Almost 25% looked for shopping at cheaper stores in the fall of 2024. Interesting enough, that actually fell off in the spring of this year and the fall of this year. So I think that is interesting. Bought fewer non-essential food items like ice cream. 22% bought less. 23% bought less the spring of this year. So I think depending on who you are as a consumer, what you like, what you dislike, what you feel is important, what you need. Some people think they need their ice cream fix, their chocolate fix, their junk food fix. Some people will just focus on the necessities. And as prices remain high, different people are going to focus on different things. But make no mistake about it, prices are a lot higher than they are a lot higher today than they were a few years ago. Our third and final quick hit talks about the companies toning down their price hiking talk. I think they just didn't want to look like they were against the consumer and going against the consumer. Our one chart on this clearly shows that in the quarter 3 of 2025, only 28 people or 28% talked about price hikes. Q2, 51, and Q1, 90. Unbelievable, right? 90% of businesses were talking about price hikes when they had their conference calls or just in general when they were speaking to investors. So clearly see how companies are now trying to deal with these price hikes in a quieter way, trying to get more people in the door, maybe swallowing some of those costs a little more. That's what we tend to be seeing. Margins are obviously shrinking a little bit. But overall, I think they're just right now just trying to play it safe and just not talk about the price hikes, even though tariffs have continued to make it difficult for a lot of small businesses. What's my take? Now the part of the show where I get to usually take one question from the audience. And usually it's a question I get over the 2-week period. An interesting one I received this week, very general question, very simple question. I've recently received a small inheritance. Is now a good time to put it into the market? And I guess they're asking this question with all the noise we've been hearing about pullbacks and bubbles and all this corrections and all that. Should they put their inheritance in the market? Well, the simple answer is absolutely. As I said earlier, there's always a bull market somewhere. There's always a good idea somewhere. And it is the job of someone like myself, the investment advisor or the investor, to find that good idea. So when the markets are at all-time highs, yeah, maybe you look off the beaten path and look at some of the B names that aren't as highly valued and overvalued as yet. Today, with the market gone down the last couple of weeks, now maybe some of those A names like the Metas, like the Microsofts that are down 15%, which we didn't talk about today, like AMD, some of the tech names, some of the names like United Rental, which is a name like Caterpillar in the same space, rent heavy machinery, they've come down 20% as well. So today, the bargains are there's a lot more of them out there. And so if you're coming into some money and inheritance, I think it's always a good time to put your money to work. over the long term, individual investors make money, as we've seen with the charts. So with that, I want to say thank you to everybody that's tuned into our show today. As always, I hope you can take away something from our show, a piece of information. Perhaps I just put aside some of your fears that, a tech bubble is coming, or a sell-off, and talked a bit that it is healthy to see sell-offs. And a tech bubble, well, I don't think there's a tech bubble about to burst. Can technology stocks fall? Yes. And we've already seen that in some cases. Could they fall more? Sure. And that is healthy. And I think that will bring in buyers, bring in those that are buying on the dip. So as I said, thank you to all that had the opportunity and the chance to watch our show today at the time. We will be back 2 weeks from today on Wednesday, December the 10th at 12 noon, as always. And with that, I want to wish everybody a happy investing.